Okay, hi everyone. You're looking at the student template. Now remember, the accounting equation always has to stay in balance, right? Assets equal liabilities plus equity. So here we have various accounts listed under assets and under liabilities and equity. So this is our starting balance. And if you were to add all up the assets and compare it to the total of the liabilities and equity, you'll see it's in balance. So let's just go through a couple brief examples of what we're doing here. Okay, so this first row we see cash goes down by 4,000 and land goes up by 4,000. Remember, the accounting equation has to stay in balance. So one asset, cash, is going down, one's going up. So this transaction means that we spent 4,000, so cash, our business asset cash goes down, and land went up 4,000. We spent 4,000 and we bought land. Let's go through another example. Look at this second one here. Now we see office supplies went up 1,000 and accounts payable went up 1,000. Accounts payable is a liability. A liability means we owe something to somebody else. So what did we do here? We must have purchased office supplies on account, right? Office supplies went up. That's an asset. The office supplies have future economic value to us. And accounts payable went up also. Accounts payable represents our obligation to pay our vendors or our suppliers. Vendors and suppliers are terms you can use interchangeably. And our vendors or suppliers gave us the ability to purchase items from them on open account. That means we take legal title to those goods today in exchange for our promise to pay for those items at some point in the future, probably in 30 days. So at this point, we have an obligation to pay $1,000. Since assets went up and liabilities went up, we're in balance. We'll take a look at one more. Okay, here we see accounts receivable increased by $1,900 and revenue went up by $1,900. What this means is we had a sale. We recorded revenues on our income statement. Revenues less expenses belong on the income statement, and they make their way related to the equity, okay, of the business. So equity goes up by $1,900 as a result of those revenues, and we have accounts receivable, which you can think of as the opposite of accounts payable. This is where we've sold goods to our customers in exchange for their promise to pay for those goods at a future date. So it's not cash yet, but it will be once we collect the funds. Okay, this is just a brief demo to get you started on ACCT203 IP1. Okay, I've got other videos available. There's one on debits and credits. I think you'll find that helpful. By the way, if you go to the second tab of this spreadsheet, you'll find the rules of debits and credits. Okay, these are the normal balances for each of these accounts. But I do have another video that will go over this in more depth.